Now that we have gone through most of the major characteristics and data points around financial statement analysis, it makes sense to turn our attention towards something around the quality of financial statements. Now, what do we mean by quality of financial statements? The basic crux of this particular topic here is that we're doing all our analysis on the financial statements of a company, and the broad assumption is that the statements are correct, right? Now, that may not be true in all the cases because accounting does allow for a little bit of discretion to be used in certain cases, as well as sometimes there could be a complete misreporting in itself. There are cases in India where, and globally as well, where we have seen that companies have reported assets which were just not there, right? So basically, fictitious assets have been reported in the past, and when people find about those, then there is a serious fraud investigation that starts. A classic case in India is that of Satyam Computers, where the company kept reporting a lot of cash on the books, which was never there, right? And obviously, there is criminal investigation going into this now, where the company management as well as the auditors and the bankers to the company have been kind of put behind the bars. So the idea as an analyst is to kind of focus on the quality of statements and to basically identify if there are any red flags in whatever we are looking at in the context of the financial statements of the company, right? So that's where we're kind of going to focus on. That's what we're going to look at. So we're going to kind of cover a few topics around why is this quality check in financial reporting important. What are the various ways we can find statements be cooked? We'll look at a variety of cases where we have a sense of what was wrong with the steps that the company had taken. Then we try and kind of identify in our analysis what could be major red flags. We talk a little bit about dividend policy and understand what is bonus and stock split over the period of this set of section. So that's the first crux that comes to us. Let's begin with the first part, which is why is accounting quality important, right? Now, note that accounting statements give us a view. Accounting statements give us a view to how the company is functioning, right, in general, and its business. If there is evidence that there are dubious accounting practices that have been used, or the company is trying to mislead its investors, this is important for an analyst to take note of. Now, think about it. If you're doing analysis of a company, what are the purposes? So, try and identify why are we doing an analysis of a company. So why are exactly we doing this analysis for a company, right? There could be two reasons. There could be more actually. We generally are looking at it, but ideally either we are looking at it from the perspective of an equity investor. So that's the end goal. That when we do an analysis, we present it to someone who's going to invest this money into the company as an equity investor, or we are doing this analysis on behalf of the lender. We are doing this analysis for someone who's then going to present it to a bank, and the bank is then going to decide whether or not to give money to this company. Now, in the investment world, or if you're a banker who's lending money to a company, it is of utmost importance that we understand the actual ability of the company to pay money, right? Now, financial statements can be both designed to kind of look better, as well as there could be a fraud that is there inherent into it, right? So when you are kind of giving money as an investor or as a lender, you're looking at two components of the entire piece, where the first part is the ability of the company to repay money, right? Now let's say they're showing more sales than what they're making. They're trying to book sales early at this point of time, then they are trying to showcase a better ability than what they have today, right? The second is a little bit tougher, but you're also trying to find out the willingness of the company to repay money. Right now, this is difficult to find out because no one says that they're going to not repay the money, right? But when you look at cases like Kingfisher Airlines, you do get a sense that there is possibly evidence when you look at the accounting practices, when you look at the general behavior of the management, that there is a question mark on the willingness of the management to repay the stakeholders, right? Can we, as analysts, try and spot this early? If we can, then we have taken financial statement analysis to its logical conclusion. We're not doing analysis purely because we like dealing with numbers, but that there is an end goal, either as an equity investor or as a lender. And unless we are able to kind of identify an actionable advice to this set of stakeholders for the company, the analysis is really of not too much value. I mean, there's no point in working around calculation of numbers because that's the easy part. It is this part which we have to eventually identify at the end of the day. Will the company be able to survive? Will the company be able to repay the money? And does the company have the willingness to kind of reward its stakeholders? Right? The stakeholders could include the bankers, it could include all other lenders, it could include equity guys, it could include customers, it could include employees, whoever is basically a part of the entire group of the company. That is where the stakeholders come into the picture, and a good company tries to reward its stakeholders over a period of time, right? That is what makes accounting quality absolutely important, and it is very, very necessary for us to kind of focus on a few things when we look at accounting statements. Obviously, a lot of this comes with practice, so it's not like the first statement that you work on, you'll get a handle on everything here. But yes, over a period of time, you do need to ask certain questions that are very important when you look at financial statements, right? Let's understand, how can statements be cooked, right? Now, we'll take a few generic, cases that have been seen in the past, and then in a subsequent section, we will look at examples around all these, right? What happens if a company can book sales early? So current years will show higher revenue, right? And obviously it will show higher revenue because later we will show lower revenue. What does this do? This immediately gives an impression that the company is doing very well at this point of time, whereas all that they are doing is kind of booking sales that should have happened at a later stage, putting that early, right? And it's only going to reduce the sales later. So for example, I get a project worth 1000 crore over 3 years. It's fairly possible that I book 500 crore in the first year and 500 in the next 2 year, or 800 in the first year and 100 each in the next 2 years. Now that could give an impression that the company is doing really well at this point of time, when in reality it has not done too well, right? So that's the first part that comes in, which is booking sales early. The second way which companies try to do things is capitalizing expenses. Now, what do we mean by capitalizing expenses? Basically, capitalizing expenses means classifying your expenses. Expense is something that's gone out in that year. But think about it. Typically, when you spend money, either you expend it or you buy an asset in a company. Now, if I buy stationery, that's an expense. But if I buy a building, that's classified as a fixed asset, right? So if I can somehow classify my expense as fixed asset, right, then I can essentially depreciate it, right? So for example, let's say I am able to classify 100 crore of expense in this year as a fixed asset, which will get depreciated over 5 years. So instead of 100, I am now going to book 20, 20, 20, 20 and 20 over 5 years. So my expense goes down. If capitalization of expenses is allowed, there is going to be a problem where companies are trying or going to kind of create a scenario where they would be able to kind of reduce current costs but increase it in later years, right? Once again, the objective is to kind of show better profitability at this point of time than what actually is the scenario, right? Companies also classify, capitalize expenses such as marketing expenses and interest expenses. We will look at examples related to these as we go along. Then the third case could be that a company classifies non-recurring income as operating income, right? What is non-recurring income? Non-recurring income is typically income which is one time in nature. When you say one time, it could come because of sale of assets. It could come because of closure of a business unit and then you're selling that business unit out. Sometimes companies have diverse assets, diverse businesses, and they may choose to kind of close down one or the other at various points of time. Now, bad year, in a bad year, you may want to kind of increase your sales by classification of this non-recurring income as an operating income. You might claim that this is other operating income, but it in reality is a one-time income that has come in. It can't keep coming again and again, right? So in that year, you try to increase sales, but in subsequent years, obviously, this is not going to come back again, right? Then you have classification of operating costs as non-recurring costs or investment. There are examples where a company which has basically tried to classify an expense again as an investment and said that what is necessary and necessarily an expense has been kind of put in as an investment for the company. So it's similar to what capitalizing expenses does, but with the additional point that there is an operating cost. Let's say something like a bonus which is paid out, right? Now company claims we have paid out a one-time bonus to employees, right? Is this a one-time non-recurring cost, or is this something that you need to use in the salary cost of the company? Now, it's quite possible that for 2 years the company pays lesser salary, but in the third year it ends up giving a one-time bonus, right? Now, the company might claim that it's a one-time non-recurring expense, but the reality is that if the salary should have been 100, 110, 120 in the 3 years, the company might have done 80, 90, and 150, saying that the non-recurring portion comes here. But in reality, in the first place, the salary should have been this, right? So there are chances that the company might classify what is essentially an operating cost as a non-recurring one-time cost or treat it as an investment, right? So we have to be careful about looking at some of these statements as well. Let's clear this as we look at the rest of the data points. High proportion of unsecured loans. Now loans could be of two parts, secured versus unsecured. Secured is typically backed by collateral. There is a security that is given in lieu of the loan, so a building, etc. Unsecured loans typically have general claims. Now, when you look at banks, banks would mostly look at giving secured loans, usually from banks, right? Unsecured loans could come from other companies, which could essentially be group companies, right? Now, for example, the same owner owns companies A, B, C, and B lends money to A at maybe 5% interest, right? Now that's not a great idea because in India usually interest rate should be around 8 to 10%. If B is lending money to A at 5% interest, then B is losing money in this proposition at the expense of A, right? A is making money at the expense of B in this case, because A should be paying at least 10% to B. But that's not happening here, right? So that you could try and find out, that why is a company taking more unsecured loans? And usually unsecured loans should be costlier, right? Because there is a risk involved. So either you are taking it from a group company where you are trying to reduce the cost that way, which is not really a good practice in general, because then you could use the other way around as well. At some point of time, A might give money to B at a lower cost as well. And B, if there is a higher proportion of unsecured loans, then in reality it should become more costly. And why is the company doing that? That needs to kind of come up in our understanding. Then we look at something like discretionary use of depreciation policies to boost current earnings, right? Sometimes companies might resort to doing this, although this is not very relevant because you can't really significantly alter depreciation policies. Then you can use reserves for offsetting losses. Now, how does this work? Remember, in our balance sheet, we have reserves on the liabilities side and we have some assets on the asset side. Now, if we mark down an asset, right, take for example inventory. If you mark down an inventory, if you mark down the inventory, that marking down will result in a loss. That marking down will result in a loss that should go to the P&L, and that loss should then get moved to the reserves, right? You add whatever profit or loss that happens to that year to the reserves in surplus for the last year. So that's how the general movement should be. Now there is a possibility that a company just knocks down the asset here and knocks down the reserve here, bypassing this entire portion. You just don't see it in the P&L. What does that do? Essentially, most of us look primarily at sales profits of the company to understand how well they are doing. In this kind of a scenario, the company might just move out of using this data in the P&L and just reduce the assets on one side and reserves on the other side, such that the balance sheet size reduces, but there is no impact on the P&L. You just don't see this impact on the P&L, right? Whereas in reality, if the balance sheet size has gone down, you should be seeing an impact on the P&L. That balance sheet size should go down because there are losses, and the losses get carried to the reserves. Now there are cases where companies don't do this. They just directly go and reduce the reserves and reduce the assets on the other side, and that is going to be a problem. It comes up. Finally, substantial goodwill not being tested for impairment. Remember, we said that goodwill is when the company has overpaid for an acquisition, right? Now, when you've overpaid for an acquisition, if you've paid 1500 for what is worth 1000, then essentially you need to kind of check every year whether that exists, that overpayment will be received back, right? So if you pay 1500 for a company that is worth 1000, every year you have to kind of keep checking whether if you sell this company now, will you receive that 1500 again, right? Now that may not happen in reality, right? And companies may just not test it for impairment. And if you see that goodwill is constant over the years, then you do need to question the management as to, are you really testing it every year for impairment? Remember, goodwill cannot be amortized. It has to be tested for impairment every year. And the basic test of impairment is, I overpaid for a company. Will I get back this money back if I were to sell this company again today, right? That's basically the test. So the broad point we're trying to make here is that you paid extra. Now you have to test if you will recover this money ever. If you do not, then you have to. If not, then book a loss because you've overpaid. And that impairment testing has to happen every year. Some companies do it. For example, Tata Steel did impair goodwill in 2013, right? Dr. Reddy's did impair goodwill in 2008 and 2009. They basically went and overpaid for an asset and then realized it is not going to fetch them the same value if they sell it, and it was a bad decision. Bad decisions happen in businesses, but the ability of the company to accept that it is a bad decision is what shows good accounting practices, right? Or in general, a care that the company is taking towards shareholders or stakeholders. Now, note that these are some examples that we have seen so far. This is not an exhaustive list. There could be 10 different ways, which we have not discussed here, where companies might either be aggressive in terms of their accounting practices, or they might try to kind of mislead investors and analysts in terms of what they are doing here. So it is important for us to identify any such aggressive accounting policies and say that this is not really the most conservative accounting policy. Remember, accounting is based on a conservatism principle. You have to be conservative in terms of your accounting policies, because that's how accounting works. That's the basic premise, that you assume the worst case and then work from there. Now, you can't use the laws that are available in accounting to kind of show aggressive accounting in order to kind of mislead either the investor or the lender just to show good growth at this point of time. And why does this happen? What is important is for us to also understand, why would a company end up doing all this? You know, so why does a company do all this? That's because of the incentive structure for the management. If I am the management of the company, I am the CEO of the company, my bonus depends on near term performance, right? And that's where I think it is important for a company to kind of have a proper governance structure where this kind of short term measure is kind of checked. In general, that is for what companies have board of directors. So whose responsibility is to check this this portion? That is where the companies have a board of directors who basically look at this entire premise of corporate governance. That's an important point, and that will keep coming again and again when you look at financial statement analysis and valuation of companies, purely because this is where a company will have a board which will come and stop the management from doing activities which are going to be detrimental to the company in the long run, to the stakeholders in the long run, right? That's it in this particular section. In the next section, we're going to look at a few cases where we kind of spot these problems.